Alrighty, looks like the numbers are starting to slow down a little bit, so we'll get started here. So good afternoon, everyone. Thanks for spending the next 45 minutes with us. My name's Steve Wildman. I'm Vice President of Planning here at Diversified. And joining me today is Ed Lynch. So Ed, thank you again for your time.
Welcome.
We're here to talk about everyone's favorite topic, taxes. And being in January, this is a great time to start talking about taxes with some updates we have in 2025 and so forth. So we're thrilled to welcome Ed, who is a seasoned tax professional for over 30 years. Ed has experience working with individuals, businesses, nonprofits, etc. And he's really great at navigating the complexities of tax planning, financial strategies, etc. So Ed, I'm gonna embarrass you a little bit by reading your credentials here. So since you don't like talking about yourself, I'll do it for you. And then I'll hand it over to you for your prepared content. So folks, Ed has about 20 to 25 minutes of prepared content for us all. And if you have any questions, feel free to use the Q&A function at the bottom of your Zoom screen. So if you have a question, you can click on Q&A at the bottom, type your question in, and if we have time, we'll get to it. And if not, we'll follow up with you after the webinar. And I also encourage you, if you have further questions, reach out to Ed or your financial advisor here at Diversified as well. So like I mentioned, Ed's impressive credentials include a bachelor's from University of Richmond, a master's of taxation from Villanova, local school here, and CPA licenses in both Delaware and Pennsylvania. So beyond his expertise in the world of tax, Ed also is deeply committed to his community, serving leadership roles for several organizations around the area, as well as coaching soccer. So with that, Ed, I'm going to drop off the screen and hand it off to you.
Hey, thanks, Steve. And hello, everybody. Apologize for my voice in advance. I am getting over that couple-week cough and cold, so I will keep coughing to a minimum. Welcome to Diversified Tax's first webinar, and mine also. So please bear with me. Today we're going to talk about a couple things, some tax changes for 2025. Tax saving tips for individuals, tax business owner tips, and some retirement and estate planning updates. And as Steve mentioned earlier, we'll also chat about, or we'll also take some of your questions and try to get you answers. If I don't know the answer off the top of my head, we'll get back to you with the answer. So let's get going. So for 2025, the federal tax brackets are changing a little bit, just more being adjusted for inflation. There's not a lot of big jumps between brackets between 24 and 25. That all could change at the end of 2025 if the 2018 Tax Act or parts of it are not renewed, and we'll chat about that in a little while. Standard deduction is going up, so for 2025 it's going to be $15,000 for single filers and $30,000 for married couples filing joint. If you are at a certain age, you'll get another couple $1,000s onto your standard deduction. For those that have kids under 17 at the end of a tax year, you are eligible for a $2,000 child tax credit. If you have dependent, and they have to be dependents, if you have a dependent who's 17 and older at the end of the tax year, that credit is $500. There are some income phase outs. If your adjusted gross income and you file as a single or had a household is $200,000 or more, that credit gets phased out. If you're married and joint, that credit gets phased out when your adjusted gross income hits $400,000. Go to the next slide. For, so as many of you know, as you chat with us during the course of the year, there are ways to reduce your taxes. And there are several listed on the screen. The first one is, maximizing out your HSAs, FSAs, and 529 plan accounts. FSAs are flexible spending accounts that are a employer provided benefit. HSAs are what we see more of, and HSAs are a great investment tool for people who don't necessarily need to use the funds for qualified health costs. The HSAs you have, so basically during the course of the year, you can, as long as you're part of a high deductible and HSA eligible insurance plan, you'll be able to make contributions directly to the HSA account. You can have them withheld from your paycheck through your employer, or a combination of the two. You have until April 15th to put funds into your HSA account for the prior tax year. So for 2024 taxes, if you haven't maxed out your HSA or you haven't put more into your HSA by the end of the year, you have until April 15th to make that contribution into the HSA plan, and it acts as a deduction on your federal taxes. Depending on the state you live in, it could be a tax deduction there. In Pennsylvania, it comes right off your income. And so we generally tell clients not to make that final payment until we're in the process of finishing up your taxes, just so we can give you the correct number, so you don't overfund it. Overfunding causes a number of different issues that you have to jump through to bring back the excess. With the for 2025, the HSA max is $4,300, and for a family plan, it's $8,550. And if you happen to be over 55, like some of us are, you can add another $1,000 to that. Just be wary that your employer, as part of your benefit, might put money into your HSA account also. So the max HSA that you can fund for a tax year is a combination of money that you put directly into the HSA account, money that is withheld from your paycheck by your employer, and or employer funding. So you want to make sure when you add all those three up, you don't go over the max. Also, one more thing on HSAs is you want to make sure, if you're about to start Medicare or getting on the Medicare Part B, there is an HSA rule that you basically have to go back 6 months from the date that you're going to go on to Medicare, and 6 months prior, you have to stop funding the HSA, because Medicare is not a HSA eligible health plan. So if you're going to be, again, just to summarize, if you're going to be going on a Medicare on a specific date, take that date, go back 6 months, and that's when you should have all HSA contributions stopped. And you can prorate them for the year. So it's not like you lose it for the whole year. It just gets prorated. Another thing is qualified charitable distributions. If you are over 70.5, you can, for the 2025 tax year, you can put in you can basically do up to $108,000 of qualified charitable distributions. And what that does is, if people who are at 73 and have their RMDs, they can take their RMDs and use the qualified charitable distribution slash deduction. And what that is you can tell your traditional IRA provider, administrator, that you want to make contributions to qualified 501c3 charities. Most have a form that you fill out, and you basically list the charity and the address and the amount, and from your traditional IRA account, the administrator will send the check to the charity. So what happens is, if you, just as an example, if you have if your RMD is $110,000 for 2025, and you decide to fund 108,000 of qualified distributions, you're ultimately taxed on the net difference, which in the examples, $2,000. You can, as I said earlier, you can use that as part of your RMD. The one caveat to the qualified charitable distributions is you can't count the payment to the charity as a charitable deduction on your Schedule A if you itemize. So you can't double count. But that's a good planning tool for people who have fairly high RMDs, and it reduces your taxable income, and you get money into charitable hands. Year-end tax strategies, and this applies to 24 and to 25. As we've been doing a bunch of tax plans in the fourth quarter and in the last couple of weeks, what we have seen is people are looking to save tax, and obviously, and as in years where clients have higher income than normal, or they have some excess income, what we've been advising clients to do is to potentially open up a donor advised fund. A donor advised fund is a separate investment where you can contribute cash, or you can contribute appreciated securities into this fund. And when you make this contribution, it acts as a tax deduction in the year that you make it. With a donor advised fund, the great thing about it is you might be planning to do some charitable giving over the course of years, but you're not exactly sure where or who yet. With this donor advised fund, you can open it up, make the contribution, you get the charitable deduction, and then the money sits in this donor advised fund, and depending on who you go with, and a Diversified does help tax professionals, or sorry, Diversified planning does help clients open up the donor advised fund. And what they do is you put the money into the account, and then you choose how you want it to be invested. I've seen short-term, mid-term, long-term strategies. So when you put the money in, it will not just sit there, it will grow with the stock market and how you want to invest it. And then when you do decide to start to do charitable giving, you can contact the fund and they'll disperse out the money. And a donor advised fund is not a one-time shot. You can do that. You can fund the account every year, or just do a one-off. We also saw clients do a lot of Roth conversions in 2024, and we'll continue to see them in 2025. Excuse me. With the Roth conversion, we see a lot of that where the client has a lot of traditional IRA of value, and their RMDs are going to be significantly high. And when you do the Roth conversion, it's income for the IRS purposes when you do the conversion. So basically, you're taking it from a traditional IRA and you're putting it into a Roth IRA, which will be there for when you retire, and you can start taking that out tax-free with certain guidelines. We've also seen a planning tool that is more geared towards Pennsylvania. I know Delaware has a similar one, but not quite as robust. With it's called the EITC Educational Credit, and what that is private schools, churches, organizations are setting up these funds where you put in a dollar amount into this fund, and you actually become a member of the LLC, and you'll get a Schedule K-1 at the end of the year that shows your share or your contribution into this type fund. And what it does is it can create a Pennsylvania tax credit of 90% of what you put into it. Not a tax deduction like a HSA or a Section 529 plan contribution for Pennsylvania purposes, but is actually a tax credit. So if you're somebody who pays quarterly estimates to Pennsylvania and you want to get some money over to your kid's school, your church, and any qualified organization that sets up this type of plan, you'll get a Pennsylvania tax credit. The remaining 10% of whatever you contribute will be treated as a charitable deduction on your federal Schedule A, if you itemize. As I mentioned earlier a couple times, 529 plans, they are a good tool for paying for educational costs. For Pennsylvania purposes, you can get a tax deduction up to, for 2025, it would be $19,000. So basically, you're able to put in for each of your kids, or actually, it doesn't even have to be your kids. It can be a grandchild or a family friend. You could put money into their 529 plan up to the maximum gift tax amount, which for 2025 is $19,000, and that acts as a tax deduction for Pennsylvania. And last planning tool that we see a little bit of, and this is more for our clients who have incurred a high capital gain, usually when they have sold their business or have sold a portion of the business. There's an investment out there called Qualified Opportunity Zone investment. And what that does is it can potentially shield that particular capital gain for, I believe, up to 8 to 10 years. I'm just giving you the high levels on that, but that may be something that if you incurred a sizable capital gain in 2024, and depending on the date of it, or in 2025, it might be something to think of. And we'll go on next slide. A business owners, there you have a couple different avenues to depreciate the fixed assets that you have purchased during the course of the past year or for the current 2025 year. You can Section 179 the expense, and you could basically purchase up to about 1.2 million of fixed assets during the course of the year, and you could take Section 179 expense on that. With Section 179 expensing, you have to have a profit in order to take the Section 179 expense. If you have more fixed asset purchases than a profit, you can choose to take the 179, but any excess gets carried forward to 2020 to the next tax year. Another avenue to which was very popular up until this last year, to where it was 100% bonus depreciation. Well, as part of the 2018 Tax Act, that percentage is coming down each year. So for 2024, there's basically any fixed assets that you purchase, you can take a one-time bonus depreciation of 60% of the cost. And in 2025, it's 40%. So it's going down each year. So as we prepare business returns, we look at which method is better, and sometimes it's a combination between the two. The biggest difference between Section 179 and the bonus depreciation is, for bonus depreciation, your business can have a loss and still take it. There's also, for commercial rental properties, certain improvements such as HVAC systems can potentially qualify for a 15-year depreciation on it, and also eligible for Section 179 and the bonus depreciation. Normal leasehold improvements on residential rental properties and certain commercial leasehold improvements are written off over between 27 and 31 years. And finally, on the business side of things, as our business owner clients, you've seen where since 2018, a lot of you have qualified for the 20% qualified business deduction. And that is calculated based on your net profit. And there's a couple calculations that need to be done, but it certainly has helped out a bunch of business clients, and that's one of the 2018 Tax Act items that could expire by the end of the year. 2025 tax planning, just to round that off, it will be most likely parts of the 2018 Tax Act will be renewed. Some might be changed, and some will go away, and we keep on top of that. So as we learn things, we'll certainly let you know. Retirement update, we spoke about some of this already. RMDs for your retirement accounts is RMD starts at 73, and age 73. And if you missed your RMD, and you realize it as we're preparing your tax return or after it's prepared, please let us know, because there's a form that we can file with your return, or separately if the return's already been filed, that will ask the IRS to waive the now 25% penalty. Excuse me, 2024, and before it was a 50% penalty. And the IRS is pretty lenient if you file the form and you basically have corrected the issue. Just try not to do it again, because the second time the IRS gets a little bit more cranky. Estate tax exemption is for 2025 is 13,990,000. That is, when you are at that level, you definitely want to be chatting with an estate lawyer about shielding your assets, transferring assets, so that you don't hit that exemption, because then the federal inheritance tax kicks in. And as I mentioned earlier, the gift tax exemption for 2018 was 18,000, and for 2019 it's 19,000. Excuse me. If you decide to gift more than that to a particular person, then a gift tax return is needed. A gift tax return doesn't create a taxable event. It basically takes the excess estate tax, or the gift tax exemption, and it reduces your estate tax exemptions total. We handle gift tax returns for clients. We'll be happy to chat with you about them, and to make sure you're compliant there. One more thing about the 2018 Tax Act that they're talking about now, and we'll see what happens, is there's talk about adjusting what's called the SALT limitation, which is state and local taxes and real estate taxes that prior to 2018, you could take the full amount as part of your itemized deductions. 2018, it was capped at $10,000. Certain states have gotten around that, so they are talking about that. And last but not least, deadlines. For your personal taxes, the deadline for the 2024 tax filing is April 15th. S corps and partnerships are March 17th, and C corps are April 15th. And that is time for some questions.
All right, Ed, thank you. A lot of information there. So just a quick reminder for those that are familiar with the diversified enterprise. So obviously Ed, on the tax side, Ed and team do a lot of fantastic work for diversified tax clients, and as well as our wealth clients on the wealth management side. So our wealth advisors and financial planners consult with Ed and team quite frequently on different situations regarding tax within a client's situation. So if we don't get to your question, or if you have any questions that come out of this, I would highly suggest that you reach out to Ed and team, or reach out to your wealth advisor to answer those questions. But with that, Ed, we have a few questions here, and I'm going to try to combine some that are around the same topic here. And the first one, and I'm just going to go in chronological order as far as when they came in. At what age does additional money, I think you were referring to the child tax credit in the beginning of your presentation. Mm-hmm. So you mentioned something about having additional money within the child tax credit topic. Does that sound familiar?
Yeah, so with the child tax credit, if you have a dependent, and it has to be a dependent who is under 17 at the end of the tax year. So at the end of the tax year, if they're 16, and you're within the income limitations, your child tax credit is $2,000. If you have a dependent who is 17 and over, then that credit becomes $500.
Yeah, that answers that. Thank you very much. Going back to HSA, so the question is, how far can someone go back in time when making HSA claims? Is there any formal paperwork? Second question, is there any formal paperwork involved, or do we just need to keep receipts?
So with the, I think you were talking about HSA disbursements.
Correct.
So you want to, so the, excuse me, the rule of thumb is you want to keep all your tax records for 3 years. So that's all your receipts, all HSA related receipts, tax returns. You want to keep everything for a minimum of 3 years. You can certainly keep them longer because the IRS statute of limitations is 3 years.
3 years. It's good to know. All right, moving right along. Questions are flowing in here, Ed. You must have hit a nerve somewhere in your presentation, so nice work. Going back to or sticking with the HSA topic, question came in. This is more, I guess, a clarification that my understanding was that even if you sign up for Medicare Part A, but not Part B, because you have health coverage through your employer, that you have to stop HSA contributions 6 months beforehand. Am I correct in my understanding?
Yes, and I may have mentioned Medicare Part B in my earlier. It's basically when you signed up for Medicare, and the date that you go on the plan, that's when you have to go back 6 months.
Got it.
And unfortunately, the literature out there, either from Social Security, Medicare, or on the internet, the literature is very confusing and not all standard.
That's shocking, Ed, when it comes to taxes. Thank you for that. And by the way, folks, I know it was said in the chat, this will be recorded, or this conversation is being recorded, the webinar, and will be sent out via email at some point in the next week or so. So if you missed something, or if you wanted to go back and confirm something in your head that you think you might have heard, this will be sent out within the next week or so, this recording. Next question, moving on to the donor advised fund topic. So the first question was, can you spell out donor blank blank? So it is called a donor advised fund. And the question is there a minimum required to open up a DAF?
I'm not required. I'm sorry. I am not. I don't believe there's a minimum. I think it's sort of, it most likely depends on who you go with to set up the donor advised fund. But I'm not aware of a minimum.
Okay.
And typically we've seen donor advised funds that are funded with 25,000 or more up to $100,000 or more.
Okay. And just as a secondary answer to that question, the diversified wealth advisor that you're working with, or that you might work with in the future, can certainly advise you on that process and execute on any of the things that Ed mentioned, especially specifically the donor advised fund in this example. So next question. I read that 529s can be rolled over to a Roth via the Secure Act. When rolled, what rules and whose Roth, i.e. is it the donors or the beneficiaries?
So I'm going to give you sort of a high level short answer because I don't know the rules specifically. That's a 2024 I believe tax change. So we'll get back to you on the exact rules, but There's, you can basically take your 529 plan accounts that you no longer have kids or yourself who need or have educational costs, and you can take that and roll that into your Roth IRA. We'll get some specifics for you.
All right, more to come on that. And we have about 9 minutes or so. We should be able to get through all these. So next question is regarding treasury bond or T-bond federal government interest. Is treasury bond interest tax exempt? I think I read at some point that it was on the state level at least.
So U.S. interest from bonds and related U.S. backed or U.S. Treasury issued are the interest income is taxable for IRS purposes, but not for state purposes. And many of you are in mutual funds that have part of the U.S. treasuries in it. So your 1099s at the end of the year indicate to us which part of the income should be classified as a U.S. interest.
All righty. Next question is around 529s. If someone has young grandchildren, and this is also a question for your wealth advisor, I would say as a precursor to this, should I set up a 529 now, and what are the tax advantages to this, if any?
If you're a Pennsylvania resident, it acts as a tax deduction. State of Delaware has a similar type of deduction, but there's some income limitations last time I looked at it. But if you're a Pennsylvania resident, it will act as a tax deduction against your income.
Okay. And just as an aside, if your question does not get answered, feel free to reach out to us. We can get you an answer for that. A few more here. When someone reaches age 73, what is the approximate percentage of RMD for that year? I heard it's about 4%. Go ahead.
Yeah, so I don't know an average because it's a calculation that a lot of times the IRA administrator will provide to you, and it takes into account the value in the account and also your age and your life expectancy based on actuarial charts. So I don't have a percentage because it differs across the board.
Yeah. That sounds like something that we can come to you for an individual conversation.
Yes, yes.
Next one is the gift tax exemption for a married couple, higher than $19,000.
Yeah, so a couple each has a $19,000 gift exclusion. So if the couple has a child or a family friend, and they can each give up to $19,000 each. If the child or person is married, each person can give each of the married people up to $19,000. We do caution people that if you're going to get up to the max, the IRS considers a gift everything during the course of the year, holiday, birthday, and straight money.
Understood. All right, a couple more here to go. Excuse me. Back to the HSA question. I'm over 65 and still working, or anyone over 65 and still working. I'm on my employer's health insurance, but have signed up for Medicare Part A. Can I have an HSA?
If your employer's health insurance account that you're a part of is HSA eligible, you should be able to continue to make contributions.
Pretty straightforward. All right, last one, folks. And then, like I mentioned, if you have specific questions regarding your personal situation, or if we didn't get to your question within the question pool here, feel free to reach out to us and we'll get it answered for you. So last one, Ed, maybe we can stump you. Can you contribute to a 529 now and have it count towards 2024 like you can with an IRA contribution?
I believe you can. The date is escaping me, so we'll get back to you on that. We generally tell people to try to fund it by the end of the year, but I believe there are certain circumstances where, excuse me, where you can make a contribution in the current tax year for the prior one.
Okay. Well, Ed, appreciate you going in front of the firing squad, especially with not feeling 100%. I certainly hope you feel better. That went through my household not too long ago myself. So I definitely know how you feel. But folks, thank you so much for attending our webinar. We look to do a lot more of these going forward. So keep an eye out for diversified emails and signups for these sorts of events. Really appreciate your trust and your partnership, whether you work with the wealth advisors or diversified tax or both. Certainly appreciate that. And hope everyone has a great week. Take care.